Hey, good afternoon, I think, everyone. We'll get started here in 1 minute while people are filing in here. I want to do a quick audio check, though. I was having some mic issues a few minutes ago, and I was cursing at my microphone before I got on here, so hopefully it's working. Can anyone hear me? Let's see. All right. Thank you, Jim. Hopefully I'm coming in loud enough. Cool. All right. If I am too low, thank you, ladies and gentlemen out there. If I'm too low, definitely let me know. Zoom has not been nice to me the last few days. But good thing I heard talk about real estate, and I'm not here to be your IT person, huh? All right. Jules, coming through on your end? All right. Cool. Well, I got my screen share in here. I will officially kick it off in like 1 minute. But please keep this interactive. Ask questions throughout here. I always love answering them. Plus, a lot of times I learn a lot of stuff from the audience as well, especially in nuanced topics like what we're talking about today, which is going to be IRA investing. So let me get this. Go in here. You can use the chat box or the Q&A. I'll be keeping eyes on both of those. Cool. All right. Well, welcome to this webinar on how to use a self-directed IRA or a 401k to take control of your investments and diversify your investments if you want to from traditional stock and bonds. So I've been doing this for a couple years, and I recently rolled over just under $300,000 from an old IRA into a self-directed 401k so I could invest in more real estate. Now, the whole goal of this is for you to walk away with a practical understanding of how to use self-directed retirement vehicles. Now, I say practical, just I'm going to give you a high-level understanding of how the vehicles work. But most importantly, I say practical for what I've seen from the real world investing side. So I am not going to go into all the details of the various things on how the accounts work, tax consequences, certain considerations if you can do it in your situation, your business. I am not your tax professional. I'm also not a qualified custodian who sets those things up. And anything I talk about in investment related items is just more for examples. I'm actually showing a lot of deals that I have invested in or I will be investing in over the next couple of months. They are not solicitations for investments. If you are interested in deals, let me know. And if you are interested in setting up your own self-directed account, let me know as well. And if you do need help in setting up your self-directed retirement account, I definitely look into Equity Institutional Services. They focus on helping people set up a self-directed account so they can go invest in the type of alternative investments they want to. There's a QR code there, and their website is trustetc.com. When you talk to them, definitely let them know that you came from Chris Lopez and Property Llama, and a big thank you to them for sponsoring this webinar. So, if you guys don't know me, my name is Chris Lopez, and I'll get into a lot more of my story here as we go into it. But here's a punchline. I am an investor first. I got into real estate a little over 10 years ago because I wanted to create financial freedom for myself, my wife, and my 3 daughters. And throughout that, I have founded Envision Advisors, which is a Colorado-based investment-friendly brokerage firm, and also the co-founder of Property Llama, which is our website that helps people understand their portfolios. So the agenda today is I'm going to just quickly go through kind of like my track record on stocks versus real estate. I think a lot of you guys can probably relate to it. Then we'll go through a high level basics on self-directed IRAs versus 401ks, and then go through some tactical and practical investment opportunities in real estate, specifically 3 of them. Then I'm going to share my retirement investing strategy and also talk about some advanced Roth conversion strategies that could potentially save you a bunch of money in taxes. All right. So as we go through here, don't be shy with questions. All right. So I started out my career and my life as very, very heavy in stocks and bonds. I actually graduated Virginia Tech in 2005 with a financial planning degree. So I went through a bunch of classes on, understanding the stock market. If you guys know what the Black-Scholes model is, I had to do that stupid derivative by hand. And if anyone out there can relate to that, let me know. But I came out with the understanding of the stock market and also thinking that I'm going to become get rich through stock market investing. So I went out there, started a business, made money, and then had some financial freedom in terms of I didn't have to work 10 hours a day on my business. I could work a few hours a day. And then I spent, because I created a bunch of cash flow for my business where I could live off of it, work some of the business, and I wanted to take some of the extra time and the extra income and go out there and obviously multiply it in the stock market. And this is just an image I got off of Google, but I literally had 6 computer monitors I had set up when I did this. I had 2 that I looked at for my business, then I had 4 for day trading, and it was 6 computer monitors. So I spent the first, I don't know, 5 months or so doing day trading on the stock market, did not have success. And I really pivoted over to foreign currency trading. And foreign currency trading or Forex is no longer popular like it was. This was all pre-Bitcoin and pre-crypto, but that was kind of like the hot alternative to the stock market like crypto is today. Well, I spent about 18 months, and probably about 30, 40 hours a week of trading, studying on both those platforms. And here are my results. Really, 2 things happened. I underperformed the stock market if I just had put it into a mutual fund, not even an index fund, a mutual fund with fees. I still underperformed that, meaning I did not do well. And when you put into like my hourly rate, I was probably making maybe, 10 cents an hour. And then the other thing is my eyesight literally got worse because I was staring at computer monitors for like 12 hours a day. And so from not making money off of there, my eyesight degrading, and also just, I don't know, I don't like sitting behind a computer screen for 12 hours a day. I realized I needed to pivot. So I pivoted my stock investing over to index investing, and I really aligned with kind of Warren Buffett's 90-10 strategy, which is 90% in like a stock market fund or the S&P 500. So put 90% in, a broad stock market ETF or index fund. So you capture all the stock market ups and downs and all what's happening in the economy with very, very minimal fees, which I'm a big fan of, and about 10% into a bond fund. So it's just more liquid and having some income from there. So I went completely hands off because basically I did a lot of active day trading. I stunk at it. So I said, okay, this isn't working. I'm going to pivot and I'm going to spend no time, no energy, and just do what Jack Bogle and Warren Buffett says and just invest in index funds with the vast majority of being equities. Now, over the years, my portfolio really bounced between like 80 to 95% stock markets. I wasn't perfect at rebalancing it, but I stayed within that theme. So once I started doing that, I then put my focus towards investing in real estate. Now, this is a chart that shows the last 50 years of the Denver metro residential prices. So I'm just putting up here for context because I know a lot of you guys and girls out there can relate to this. The solid line is single family homes. The dashed line is condos. So I started investing in real estate in 2011. So after the crash, and starting this early part of post-recovery. So I started investing, and after a couple years of investing, and then I started turning it into my career to become an investor-friendly broker. So I rode the wave of just the massive appreciation and massive rent growth. And I can't remember the exact amount of money I started with, but it was not much. It was probably around $50,000 or so. Because I lost a lot in the stock market, and then my other businesses I built, they petered off, so I didn't have a ton of capital. But I dug into a lot of knowledge, and I put a lot of sweat equity into finding properties out there, and eventually turned that into well over $1 million portfolio, and then some over the last 10 years. So when I go back and look at my stock performance, and this is sans my day trading, that was just I don't count that anymore. That was a really good learning experience. I went to school for a couple of years, paid my tuition, and didn't get a very, didn't get a great degree, to put it into a poor metaphor. So I've averaged about, 10.5% or so, with that investing of being mostly in a broad market index fund. I'm also going to historical returns. A lot of times they pay around 10%. Now, on the other hand, my real estate returns have been like 20% plus. Now, neither of these are down to the decimal point, but I'm just kind of doing some high level returns. And I think a lot of people can probably relate to this. I have seen my real estate investment returns, 2 or 3x outperform my stock market returns. I'm curious if anyone else out there has seen similar returns like that, or what your stocks versus real estate returns are. But this is a pretty common theme that I've experienced and many investors have. So after a few years of this, I'm like, oh, I got to do more real estate, more real estate, more real estate. And so I stopped putting in, or I started putting in a lot less money every year into stocks and bonds, and putting more of my capital and more of my time into real estate, because I was making more money and it was way more fun. And my eyesight was not degrading like it was when I was day trading. So most of this, when I talked about this chart earlier, all that money I made, all my returns, that was outside retirement accounts. I stopped funding some of my retirement accounts for a bit, and let a lot of them just continue to grow in, a Vanguard S&P 500 type fund with bonds. And then about 4 or 5 years ago, I actually set up in my own solo 401k. So I go out there and invest retirement funds into real estate. Now, I'm going to kind of take a step back here from stocks versus real estate, and then talk about setting up a retirement account. Now, the term is a self-directed IRA or a self-directed solo 401k. Now, the self-directed means that you can direct the investments where you want to go. So you can invest in alternative investments. So on the left here, and this is just a screenshot I got off of Equity Trust website, says, hey, a traditional IRA or a traditional 401k, you can invest in stocks, bonds, and mutual funds, and ETFs, either through a Vanguard or Fidelity or your employer's, 401k plan. On the right is just a fake portfolio showing what you could potentially invest in with alternative investments. And alternative investments are basically anything that's not a stock or a bond. So you can invest in, obviously, still invest in stocks and bonds. You can invest in real estate. You can invest in precious metals like gold and silver. You can invest in notes. You can promissory notes. You can be a lender. You can invest in cryptocurrency. You can also invest in private equity. That could be a private equity business or private equity real estate venture like a syndication. So from a high level, here's what you want to understand. The self-directed IRAs and 401ks essentially have the same tax advantages and the same rules that you know from traditional IRAs and 401ks, but they allow you control, and you can invest in alternative investments. Now, the IRAs and 401ks are different vehicles with slight nuances, but just for simplicity, we'll be kind of just using those words interchangeably and really just focusing on the self-directed aspects, whether you're an IRA or 401k. We'll talk about how you can invest that in alternative investments like real estate. So some common uses when it comes to comparing a self-directed IRA. So I see a lot of people where they will have a previous 401k from an employer, and it might be still sitting at their previous employer, or they rolled over to a traditional IRA. So a 401k rollover to a traditional IRA. And a lot of times there's, big chunks of money, $50,000, $100,000, $250,000, $500,000 money in those accounts. And then you can convert those or roll them over to a self-directed IRA. Now, a self-directed 401k is what a lot of times you have, think about a 401k with your employer, or if you're self-employed, a 401k or a SEP or any of those type of things you can set up as a entrepreneur or as a business owner. Now, you may qualify for a solo 401k if you are self-employed and you don't have full-time employees other than you and your spouse. Now, again, I'm not going on the details on here. I just want to give you the high level on IRAs versus solo 401ks. Now, with a IRA, whether it's traditional or self-directed, you have the typical IRA contribution limits and rules. And I believe for 2024, those are $7,000 for those people under 50 and $8,000 if you're 50 or older. Now, with a self-directed solo 401k, you have a lot more options on there for continuing to contribute to that. So again, this is a plan for people who are self-employed. So a lot of times in real estate, these are real estate brokers, they're small business owners, they're internet marketers, they're people where they have a business, but they don't have a big organization with a bunch of W-2 employees. So you can contribute two ways: through your salary deferral. So hey, you pay yourself a salary, and then just like you can contribute up to $23,000 into a traditional 401k, you can contribute up to $23,000 as your own employee into your 401k. And on the other side, there is an employer profit sharing plan where you can contribute up to 20 to 25% of your total contribution. Now, without going on the details on here, like in 2024, for example, if you are a self-employed person with a solo 401k and you're under 50, you could contribute up to like $69,000 in total money to your 401k. If you're over 50, I think it's up to like $76,000. And this is on an annual basis, and these will adjust based on the annual stuff the IRS gives you for 401ks and IRAs. So if you're in a position to go out there and set up a 401k plan because you have a business that meets requirements, definitely look at it. Now that fits, like I said, a lot of real estate investors and a lot of real estate brokers and real estate professionals. Now, if you don't have a business, you're not self-employed, if you have a traditional W-2, this probably isn't the right fit for you. You're probably going to be more looking at setting up a self-directed IRA where you can roll over a previous 401k or another IRA if you have it. Now, important disclaimer, I'm going to give this a few times throughout here. I am giving you the high level of it. I am leaving out a lot of important details and nuances. For example, required minimum distributions and also unrelated business income tax, or UBIT. Make sure you talk with a tax professional and you reach out to a custodian like Equity Trust to go out there and understand the options and what's the best fit for you. Now, again, if you want to go out there and talk to an expert, go to trustetc.com, and you can see they have an opt-in box where you can go in there and set up a consultation with one of their professionals. And also, I took a screenshot on here. There's a lot of variations of IRAs and 401ks. You can even do an HSA. I don't even know what a CESA is. So like I said, I'm giving the high level for IRAs and 401ks to help you understand the options out there and how you can invest it potentially in real estate. All right, so I brought up the screen again here that shows the alternative investments on the right here. And I'm really going to focus on three aspects of it. Real estate, and by that I mean like a directly owned rental property where you're on the deed and you bought it or you're buying with a partner. Real estate notes, like you are lending money to someone, and then private equity, syndications, or passive investing on there. So as I go through this, please ask any questions. Now, I don't invest in crypto. I don't invest in precious metals, so I'm not going to speak on those. Go talk to someone who's a lot smarter on those topics than I am. So let's talk about the first one, which is investing in real estate directly. So this could be like a residential rental property. It could be a fix and flip. It could be a commercial property. So, an office building, a retail strip center, a big multifamily building. You can invest in raw or developed land. You can invest in farmland. You can invest in mobile homes. I think you get the point. There's a lot of different ways you can invest in real estate. So just like you can go out there and buy real estate, you can essentially do that with your self-directed IRA or 401k as well. Now, there's really two important things to make sure you know about. And these are also two reasons why I have not personally invested my self-directed 401k into directly owned real estate. The first is you're going to have to use non-recourse lending. And so non-recourse lending is when you as an individual cannot guarantee it, because since your IRA or 401k is investing on there, the only security, the only collateral they can use is your 401k, your IRA. That's a separate entity. And so if something bad happens on there, they cannot reach through your retirement vehicle and say, hey, Chris, hey, Jules, you owe us more money. So because of that, you have limited options and less favorable terms when it comes to non-recourse financing. Now, a lot of times this will be like a 40 to 50% down payment with a higher interest rate as well than you could through a local bank or through the traditional like Fannie and Freddie loans. So I've never been a big fan of the financing. It's like, well, if I'm not getting like a great leverage, a 20, 25% type down payment, I want leverage. So that's always been a turnoff to me. The second thing is there's a lot of rules around prohibited transactions. And I will definitely not go into details on here. But the biggest thing is if you want to go out there and say, hey, buy fix and flip or buy a rental property, you can't go out there and do active work on the property. You have to keep essentially an arm's length distance. And so that's because they don't want you to, use the money for investments you're working on yourself. So there's a lot of rules around there where, hey, go out there and buy a property and hey, go in there and do work myself. I can self-manage it to go out there and increase return and also save on fees and increase the margin. Well, it's really hard to do that through an IRA, a self-directed IRA, or a self-directed 401k. Now, there are other rules and nuances, but these are the two big reasons why I have not personally invested in directly owned real estate. And as I've gone through looking at numbers with people over the years, and this a lot of times was, when we used to be in the low interest rate cycle, and have a lot of clients out here in Colorado talk me through Envision Advisors. Hey, I got a self-directed IRA. I want to go invest. I'd say, hey, awesome. Here's some stuff I know. Let's get financing in place. And we would go out there and look at deals. I can only think of one investor that ended up going through because most were like, hey, once they see the terms and the numbers, like, oh, well, that's not that exciting. Oh, I can't work on the property myself. They were turned off by it. Now, I've definitely seen some people do it, but I've seen far fewer people do it. Like I said, I'm not a fan personally of owning directly owned rentals in my self-directed retirement account. Now, one option I've seen the last couple of years, I think it's worth everyone noticing, and it might be a great fit for you, is where you can invest in a partnership into real estate. Now, I've had a few clients do this where partner A is the equity partner, the person with capital in their self-directed IRA. They want to go out there and directly own real estate for all the benefits we know. But then they have partnered with someone who is more on the sweat equity side, and that person's going out there and finding the property, running the property, and a lot of times going out there and getting the loan as well. So it's been a way where they can still get good returns in the market, but avoid those two considerations of the non-recourse lending and also where you have to stay an arm's distance away. So the example that popped in my mind while I was putting the slide deck together is someone I know in Denver with their self-directed IRA is invested in Colorado Springs rental properties with a partner down there who is on more the younger side where they have less money but more time, and that partner is taking care of the operations and putting in sweat equity. And you know what? It's a good win-win for both, and it's a good fit for the investor with his self-directed IRA. All right, moving on to the second part here, which is note investing, also known as being the bank. That's how I like to think of it in my mind. So rather than you investing in equity on the property, I'm going to put down a 30% down payment, a 40% down payment, and get the loan. This is where you're the lender, you're the credit, you're the bank. So a lot of investors will lend out their money to other real estate investors. Now, typically, they're not putting on, long-term debt. This is for fix and flippers or people that need a bridge loan. So a lot of times these are, loans that are, 4 months to 12 months long. And a lot of times they get an interest rate, between 10 to 15%, plus some other fees along the way. So they get some really good returns, and it also meets the requirements of what you can and can't do within a self-directed IRA. Now, I've known a lot of investors doing this over the years, and it's always intrigued me. However, I have not done it personally where I've lent directly to, hey, Jules is out there doing her fix and flip. I'm not lent to Jules or, lent to Richard out there to go do their fix and flips. Why? Well, there's two main reasons. One is there is foreclosure risk. And I remember very vividly someone I was talking to 6 or 7 years ago, and they've been investing for years very successfully through their self-directed IRA. And they're a Colorado investor, and they had lent money on a fix and flip out of state. I don't know which state, but not Colorado, it was out of state. Well, that investor ended up having to foreclose on property. And I was actually just talking to the investor while they're going through this, and they were like using some four-letter words and saying, I don't know what to do. I have to go on this foreclosure process. I have to go travel up there now. That person was not happy, and they were frustrated. And they're like, hey, after this, I'm done doing this. This is, man, way too much headache and way too much risk. Now, industry average, I've heard this from hard money lenders, and these are often the people that are like their full-time job is letting the money out. It's not uncommon. The industry average is about a 2 to 3% foreclosure rate on short-term loans like this. So for every 50 loans you go out there and issue, I would expect 1 to 2 to potentially go into foreclosure. So that scared me because I don't want to deal with a house like, man, well, number one, I didn't have a huge amount in my 401k where I could lend out a bunch of money to make, hey, great, 10% on $50,000 with the risk of having to foreclose. Not worth the headache, nor worth the expense. The other item is I am not an expert on underwriting those types of properties, nor do I have the time to go out there and find the deals and underwrite it. So I didn't like it because of the foreclosure risk and also because of the time and the expertise of it. Now, what another option is looking at investing with a debt fund. Now, this is something I have been doing. So it's the exact same concept on here. But if you guys see the graph on the screen, I've got 3 main rectangles on here. The previous example is just private investor to the real estate borrower, where you are directly lending with the headaches and risks upside I mentioned. Now, with the debt fund, you are lending to a debt fund. So this is a hard money lender or private money where they are raising a fund, and they have, a lot of times, dozens to hundreds of investors investing between 50 to a couple $100,000 in there. And so they are usually paying a fixed rate of return or, around a fixed rate of return back to the investors. But then they're taking that money and they're out there issuing the loans to fix and flippers or to people that need a bridge loan for a multifamily value add. And so they're the ones where it's their full-time job to go out there and find the loans, underwrite the loans, deal with the paperwork, deal with the closings, deal with the draws, make sure they're collecting interest. And then that 2 to 3% of the time when a foreclosure happens, they're the ones dealing with it. So I personally love this model for those reasons that I just said. Now, some just general highlights on debt funds. You will, from my seen, typically get a lower return than if you're out there lending money directly. Well, that makes sense. You're taking less work or less risk, and someone else is doing all the work. So you're not going to get paid the same if you're doing the job yourself. So a lot of debt funds that I have seen, I've invested in, they pay out like that 8 to 12% annual cash on cash return, with a lot of times they're paying quarterly dividends. No active involvement. And the other reason I like it is because you get diversification. In the earlier sample, if I loaned $100,000 to Richard to do fix and flip, all my money is with Richard at his property on 123 Main Street. So if something goes bad, hey, I got a lot of money locked up in that one investment. Now, with debt funds, a lot of times those are collateralized across between like 50 to 150 properties. So you don't own one property, you have a fraction of 100 properties. A lot of times they're liquid after 1 year. Hey, put your money in the property after 1 year. You can let it ride, or with, a few weeks to a couple months notice and say, hey, I need the money back. And they'll give you the money back. And also a lot of times you can fund these investments for as little as $10,000. Some have higher minimums, but I've seen some that are as little as $10,000. So it takes out a lot of the headaches that I mentioned, but has a lot of the things I like about it. All right, the third item I want to talk about is investing in real estate private equity. So this is also known as passive investing or syndications or real estate funds. So to give the definition, a syndication in real estate refers to a group of investments or a group investment opportunity where multiple investors pool their resources together to invest in a larger real estate project. So what this is, it might be like a bunch of investors pooling their money together to go out there and invest in a $20 million multifamily or a $30 million development deal. So kind of like a stock where you don't own the whole company, but you own a fraction of it. And so these are ways where you can get pull your money together, get larger investments. And since these are larger investments, they have a sponsor or general partner, and they're the ones actually running the investment, all the day-to-day stuff of finding the properties, getting financing, managing the rehab, managing the property management, managing the reporting. And so you're on the limited partner side, so you're just investing the money. So I like these a lot because I get access to bigger projects. Like I love real estate investing, but I'm not at a career with my own expertise or my balance sheet where I can go out there and take down a $20 million apartment building. I'm quite a few years away from doing that. So I can take down bigger projects while being hands off with a partner who is an expert at that. And also a lot of times I can diversify my risk. Rather than having $400,000 into one rental property, I might make 4 $100,000 investments into different investments in different groups. So a lot of times too, these returns tend to be, very similar to what we can see on the rental side. And so there's some great potential on here to invest in your IRA or your 401k into real estate private equity. So something that Property Llama does, because we get this question a lot, we do put deals together like this where we have these bigger investment opportunities, the multifamily buildings, the development buildings, the debt fund opportunities, where we help structure these investments, and then investors can go invest in these deals. So these are deals, I put together myself, I invest in myself, and if you have any interest in those, let us know. But as the back end way of what Property Llama helps out with a lot of investors is we put together some of these bigger real estate private equity deals. All right, so I'm going to run through a few examples here as well to give you a little bit more meat on the bones as I talk about it. And so I won't go through all the details here, but here is a 34-unit multifamily value-add building that we purchased in North Denver. Rents were about 40 to 50% below market rents. So we went out there and we were able to take this down. Now, some people invested cash. Some people invested through their self-directed IRA or 401k. So the plan was essentially to do the value add or the BRRRR. Bought the building, estimated about $900,000 improvements between interior and exterior. And then we could raise the rents from about $815 to about $1,350. So I'd say this is kind of like a base hit type deal for, just multifamily. The property was just outdated. You can see it here was just a tired property that needed some love and some TLC. And here are the after photos, updated it, and added some amenities. And we're able to go out there and add a lot of value by increasing the rents. Now with this deal, we're estimating like a 13 to 17% IRR in the deal. And so that's the range. Hey, if you invest in the deal annually, it should be about a 13 to 17% return. I'll go into a demo of Property Llama in a minute here. And I want to come over here. I see some questions coming in. All right. Someone asked, are the private equity deals for accredited investors only? So yes and no. Majority of private equity deals are for accredited investors only. There are different deals where you don't have to be accredited. So we have both. Most of ours are accredited. But if you have interest in deals that we don't have to be, where you can be a non-accredited investor, let us know and we can get you some details on though. And also, this is where it's always a great opportunity to go out there and network with other real estate investors where you live or in online forums. Because a lot of times if you know someone or have a relationship, like, oh, I met this person at a meetup a couple of years ago and we've been in the same circle and we've talked, and you have the relationship where you trust, a lot of times they're able to take some non-accredited investors in their deals as well. So we definitely got some. Reach out to us, and then also make sure you go out there and explore your network for deals that will also work for accredited and non-accredited investors as well. All right, so another deal that I like right now is in development. There's a lot of great development opportunities out there right now because as interest rates have gone up, land values have gone down, and there's a lot less buyers. So I won't go through all the details on here, but this is, a project And this was in northern Colorado. It was a 12-unit single-family home subdivision with developer where it's around other developments. They've actually built other homes on there, and so they know the area. And also, I think makes a lot of sense where, I'm not going to go out there and develop a home myself or develop, 12 homes myself. I can invest in the project and get potentially really great returns that way. And of course, the developer needs money because they need money to go out there and help raise for the deal. And so another reason I like this is these properties are green, meaning they are built more towards energy efficient and being, greener and healthier homes. I'm all about conserving resources, whether it's money or energy or water, conserve every resource we can out there, and also being healthier. So I like that about them. And also I think it's a very unique thing in the market where a lot of buyers find it attractive. Hey, all things being equal, an energy efficient home and a healthier home a lot of times is more attractive. So another deal is a development deal. Now, this is one that I'll be investing in later this year. This is a Class A ground up development deal. I think the total project is like $40 million. So again, a very big deal, and a deal where I can bring in, basically pennies to their dollars. I'm able to invest. I'm going to invest through my self-directed 401k. Now, with this deal, it's really important. It's all about location, location, location. They are picking a primo location. That's what they specialize in the suburban, urban areas where people want to walk. They can command a rent premium, and they have a very unique product that fits that resident and also it fits that location. So here's a screenshot of one of what they should be building. It'll be about a 64-unit apartment home, and they expect to start building later this year or early next year. And I'll be investing in that once they start the next phase. And they need my money and other investors. But I'm investing all that, and I'm investing in these deals through my 401k, the three deals I mentioned, and also the debt fund. Why? Well, because for a lot of my active dollars, they're still tied up in rental properties. Like I said, I don't like the economics and the rules around investing directly in rental properties. So I have shifted most of my retirement accounts to investing in notes and these private equity deals because I get to invest in real estate. They fit the rules and regulations of 401ks. They fit what makes sense to the market right now. And I also don't have to be an expert nor put my time into there. So I want to move over to some advanced strategies. Actually, before I do that, I do want to flip over to Property Llama. Is the Property Llama screen showing up here? Okay, cool. Wanted to make sure Zoom was working on me. So this is a $1 million portfolio. Now, I wish my retirement account had $1 million in there yet. Not quite there, but I was modeling this for someone else, and it actually models the same investment. So I just kind of want to show you how that might work. So, for example, like the debt fund here, the one on the bottom, this is 12% a year it pays. So if I invest, $100,000 into it, I'll get $12,000 a year in interest. Or if I invest $250,000, I'll get $30,000 a year in interest. So another reason I like to invest in debt funds through my IRA is, the income you get from here, it's taxed at your normal tax bracket as ordinary income. So if I invested in this or bought a rental property and, with my own cash outside my retirement account, I'm going to get hit with my ordinary income tax bracket, which is higher than capital gains. So I like investing in my self-directed retirement account because I don't have to I'm not paying ordinary income tax on there. It is sheltered through my tax account. Now, going up here, this is that single family home development I talked about. Now, these are zero cash flow. It's all capital gains. But these should be a very high growth rate of return. A lot of times, it's going to be like a 20 to 25% internal rate of return, or IRR. So I've invested $200,000 in 2 or 3 years. It should be around $400,000. Again, it should be. As we all know, real estate investing always involves risk. So make sure you go out there and understand the opportunities and also the risk associated with the investments. But it's no cash flow, then all cash flow is they sell the properties. And again, I like these investments because they make sense to the market. And also, I have capital in my retirement account and I go out there and deploy in these investments. Now, this next one, this is like the Class A multifamily I talked about, where there is some cash flow in the first year or two. It's called a covered land play. There's an existing building on there. So there'll be very minimal cash flow, but there'll be a couple dollars. And then by year 4, by year 5, the property should be built, it should be stabilized, and then it should be spitting out some cash flow returns. So first few years, no cash flow. Next couple years, good cash flow between 6 to 8%. And then somewhere in year 8, 9, or 10, go out there and sell the property. And the last one is that multifamily value add investment, like I talked about, where you're out there buying distressed property. Year 0 or year 1, no cash flow. Then years 2, 3, 4, moderate cash flow. In like the 4, 5, 6, 7% range is pretty typical. And then some, the big pop, a big amount of money get back once they sell the properties in year, 4, 5, or 6. Now, another reason I like to invest in these deals in the IRA is I don't care about cash flow. This is all future money. Money outside my retirement account, that's more money I live off of today. So I am more mindful of the timing of things and also the cash flow and the tax consequences. I like to get long-term capital gains in my non-retirement account dollars because I pay a lower tax bracket. So if you guys have any questions on them, I know I'm kind of going fast and furious, but I'm trying to condense the last 7 years of knowledge into a 55-minute webinar for everyone out there. Again, if you guys have questions or want to explore these types of deals, let us know at Property Llama. We can give you some education and also show you some of the deals that we have currently in the pipeline. All right, so the last section of this presentation is I want to talk about some advanced tax strategies. Now, this is around Roth conversions. And there's always a debate. The Roth is you're paying taxes today or this year. Now, if you pay taxes today or this year, when you take the money out in 10, 20, 30 years, you're not going to pay income tax on there. So ever how much it grows, great, it grows. And when you take it out, it's tax-free. Now, with a traditional IRA or a traditional 401k, it's tax deferred today. So if I contribute to my IRA or 401k today, my 401k today, I get a tax benefit today. That money can grow tax deferred. And when I go take it out in 10, 20, 30 years, I will pay taxes on it then. So it comes down to a very important question. Should you pay taxes today or pay taxes tomorrow or in the future when you withdraw? Well, in my eyes, there's really 3 main considerations. And these are in no particular order. What is going to be your retirement tax rate? Are you going to be in a higher tax bracket or a lower tax bracket? Now, a lot of people end up being in a lower tax bracket when they retire. But a lot of those people, they're not real estate investors. They're entrepreneurs like us. They're not there hustling and putting deals together. I am optimistic about, where my finances and careers will be. And I hope and I expect to be in a higher tax bracket. That means I'm winning if I'm in a higher tax bracket. Now, that's assuming everything's the same today. Hey, the same rules, the same tax brackets apply today as they will in 20 or 30 years. Now, I seriously doubt they'll be the same because we all know, depending on who's in office and what trends are going on, different politicians have different views on taxes. Some want to lower, some want to raise. So there's the consideration and risk factor for what's going to be the tax rate in the government in the future. I'm curious out there, if we did a quick informal poll, who out there thinks taxes will be higher in the future, or who out there thinks taxes will be lower? In the chat box, I personally think taxes will be higher. That's how a lot of times, countries grow in the progression of it. We also have a lot of debt that we have, that we're accruing today, and we have to eventually pay it back. And so I see a lot of messages coming in. Every single person says higher. Yeah, so great. In 20 years, we can get together and see how our bets pay off. But yeah, I think we're all in the same camp there. Now, here's the third bullet point, and this is the one we have control over. So this is the one I focus on, right? The first 2, It's what if scenarios. I'm hedging my bets. I'm taking a guess. The third one is the most important because I have control, or I have some control. What's the average annual return? Now, there is some tipping point where if you can go out there and achieve a higher than average return in your account, it makes sense to pay money today in taxes versus later. And I say makes sense. It makes sense on a spreadsheet saying, hey, if I invest $100,000 today and pay taxes, if I'm able to go out there and earn a 15% annual return, it'll be so much money in the future. Well, if you're able to go out there and achieve those returns, it makes sense because you'll have more money in the future. And then when you draw it out, you'll take more money out and you won't pay taxes on there. So I definitely recommend you sit down and, build your own spreadsheet, look at talk with your CPA and figure out, hey, what the tipping point is for you. In my own spreadsheets, my rule of thumb is around 15%. If I'm kind of averaging I use 10% for stocks and bonds. For me, the numbers don't make sense on there because the growth rate's not high enough. But once you kind of get in the mid-teens, from my modeling and my conversations with my CPAs, that's how we hit the tipping point where I can make the case to say, hey, look at doing a Roth conversion or investing Roth today because you should have more money in the future. So from all the research I've done, there's really two options you have for getting your money into Roth dollars. The first is making Roth contributions today. So that would be like a Roth IRA contribution or a 401k Roth contribution. Now, both traditional and self-directed vehicles, a lot allow for both, but always go look to see what your plan allows for. Now, when I set up my 401k, my self-directed 401k plan years ago, I did not set it up with the intent of doing Roth conversions, or I should say Roth contributions, but I wanted to make sure it was in there. So if I decide in the future I wanted to, I could. Secondly, you could do a Roth conversion. Now, the contributions where you're putting in money like this year, hey, I'm contributing $7,000 or $23,000 this year. A Roth conversion is where you already have usually a big chunk of money from your old 401k or an old IRA, and you can convert it to a Roth. Now, when you convert it, you will pay taxes on the amount based on the fair market value and your tax bracket today. Now, again, this is something you want to talk to your CPA about because you may do it all at once or you may do some each year. Now, with some of these passive real estate investing opportunities, it actually creates a unique opportunity for you to convert at a lower conversion value. So this is essentially an accounting trick where when you convert it, the book value will be lower, and when you convert it, you'll pay taxes on a lower amount. And I'll explain in detail here in a couple slides. But first, I want to talk about making a Roth contribution. So I started doing this in 2022. Why? Like I said, based on the numbers, right around that 15% annual return, I was like, that makes sense. And I felt confident in myself and my real estate knowledge, my real estate connections. I can go out there and achieve a better return in the stock market, and I can achieve that mid-teen or higher. So I was like, well, I'd rather just pay taxes today. So when I contribute annually to my 401k, I'm now doing it as a Roth. So I'm paying taxes today on there for no tax benefits today. So I have more tax benefits in the future. The other thing, and this is something that I'm very privileged to get, is I get to talk to a lot of investors through the podcast and through the Property Llama app. And I get to meet so many successful and a lot of times older investors who are using self-directed retirement vehicles. And then two things, I see their numbers and then they give me advice. And they're like, Chris, convert it to a Roth, pay taxes today, and don't worry about taxes in the future. And when I see these people, hey, they got 10, 20, 30 years on me, and their accounts usually have a comma or a couple zeros on me as well, I take notice. But the vast majority of them who do it are like Roth, Roth, Roth. So based on the numbers and what I've heard from like mentors and investors, I was like, you know what? It makes sense. I want to start converting my contributions to Roth because I think I can save a lot more in taxes in the future versus just today. So let's talk about a Roth conversion. Now, this is the second part on there toward the existing one. So I mentioned in the title that I have about, just under $300,000 I could roll over. So let's just say $300,000 for a nice round number. Now, if I converted that while I was sitting at my Vanguard S&P 500 investment, I would pay taxes on the $300,000 fair market value. So whatever my tax bracket is times $300,000, that's what I would owe. Now, with passive real estate investing, there are two key considerations that allow you to potentially convert at a lower value based on the discount for lack of control and the discount for lack of marketability. So DLOC and DLOM, these are two key points to keep in mind if you want to do this advanced Roth conversion one day. And so what happens here is the assessor or the CPA or firm doing the fair market value, since you don't have control, and marketability means selling it. You don't have control and you can't sell it. It's worth less money because you can't sell it for today what you bought for a year ago. So the classic example is, hey, if I put it into a development deal or multifamily fund deal, hey, invest $100,000 into it, and a year later I want to go sell it. Well, it's really hard for me to sell my share in there. There's rules within the investment itself, and there's a very, very small pool of buyers that will buy it. And usually when they do, I'm going to sell at a discount. So the reason you can get this on private equity is because you have those two things. Now with stocks and bonds or even debt funds, those are liquid. So those usually are going to convert at kind of par value where you don't need to go out there and get an assessor. All right, so let me walk you through the step-by-step process of what it takes to go out there and do a Roth conversion and potentially take advantage of the fair market value of a passive investment. So first off, you want to move your IRA to a self-directed IRA or a self-directed solo 401k. So first off, you can go out there and invest in real estate. You got to make sure you can invest in real estate. Secondly, invest in a real estate deal or real estate partnership, aka passive investing or a syndication that meets those two requirements where you have lack of control and lack of marketability. And then a year or two later, go out there and hire someone to do a fair market value assessment, FMV. And probably won't be your CPA, but there are CPAs that specialize in it. Now, I've yet to personally do one of these. I've done the contributions, but I've not done the conversions. From other investors, these fair market value sales a lot of times cost me like $3,500 and $5,000. So there's a cost to doing it. And so you want to make sure that it makes sense. I guess if I'm going to spend $5,000 and time, I want to make sure that I get more than $5,000 back. I want more than $6,000 back. And so a lot of times from talking to people, it's that 1 to 2 years is the sweet spot for doing that FMV study. So I got a couple screenshots here of what a fair market value looks like. So this is just from a CPA. One of my clients shared with me and said I could use it. Obviously, if I took out all the information or redacted all the information. The standard of value used here in your valuation of investment in blah, blah, blah investment is a fair market value. Blah, blah, blah. So you go through and lay out all the stuff. And then they give you the valuation date, who did it, the investment reviewed. And you can see down here, these factors were considered. Discount for lack of control. The owner of this interest, meaning me, the owner of this interest has no control of the investment and running of the business venture. It is a manager-managed LLC. The operating agreement states the business and affairs of the company shall be solely and exclusively directed and managed by the manager, and the manager shall have full, complete, sole, exclusive authority, power, and discretion to take all actions and make all decisions regarding the company's business, and may act for and bind the company without consent or vote of the members. Now, in these deals, I'm a limited member or a limited partner. So the managing partner or sponsor or GP, they're in control. So they're stating these two facts to make sure, it stays compliant with the IRS. The second one, discount for lack of marketability. The ability to sell the investment on the open market. A member has no power to withdraw from the company. The operating agreement states no membership interest may be transferred within 1 year from the date of this agreement, and thereafter only upon the written approval and consent of each member. So we value the market discount at blank, blank, blank. So, if I go into my Vanguard or Fidelity account, I can go in there right now and sell my NVIDIA stock. And within, seconds to minutes to an hour, it's sold, and it's easy. So it's easy to value, and it's also easy for me to market. All right. So going back to the step-by-step process, from talking with investors and a couple of these CPA firms that do these fair market value studies, the ballpark is around like 33 to 35% is a lot of times what you'll get in like a write down. So let's say I had $100,000 in the investment. So I have $100,000 in my Vanguard account. If I were to do a conversion on there, I'd pay taxes $100,000. Well, if I were to go out there and do a fair market value study and I got a 35%, current valuation, well, that's $35,000. $35,000 minus $100,000 is $65,000. So if I did my Roth conversion then, I'd pay taxes on $65,000. So I'm going to pay taxes on $35,000 or 35% less. Now it comes into play. Great, I'm going to save some of that taxes. Is that worth, is that savings worth it when I still spend $4,000 or $5,000 out there for a fair market value study? Now, if it's close, it's not worth it. So I've seen it for people with, much bigger accounts where, hey, whether you have a $100,000 investment or $1 million investment, that fair market value costs the same. So there is some economies of scale on there where it makes sense, in my opinion. All right. So back to your step 4, you get the fair market value, you write down your investment. Step 5, you convert it to a Roth IRA. And that way you can convert it at that lower fair market value. You'll pay taxes today on there. And then the last step is you get to enjoy the tax-free growth and distributions in the future. So I built a spreadsheet a while ago, and I won't go into details on here because it's probably going to put everyone to sleep. But you can see here, this is a passive real estate investing with a Roth conversion. Now, I'm assuming exactly what I said on there. If I were to be able to invest, annually at 17%, so a bit higher than the 15%, I'm able to pay a 30% tax based on a 65% fair market value. And in the future, I'm going to withdraw 4% a year, and I'll pay 0 taxes. Well, when you come down here, you can see these numbers get really big. I'm going to come over here to compare these. If I just did a self-directed traditional IRA, meaning, hey, I get the tax deferral today, I'll pay taxes in the future. And then doing the analogy of what I sent, where I took the investment and did a Roth conversion based on fair market value. Well, this is about the 20-year mark. Well, in 20 years, I'll be getting about 19% difference in cash flow. So my after-tax cash flow withdrawing from my IRA is $180,000 after taxes. And then with my Roth, it would be about $213,000, or about a 20% difference. So, that's about, $35,000 on there. So I have not done this yet, because with the main reason is because I don't have a big enough portfolio. I'm like, hey, I don't have $500,000 or $1 million in these types of investments where it's kind of like worth the headache and worth the expenses, in my opinion. I might do it in a year or two. I have invested the money in there, or I might utilize it. But these are some of the examples that I have built out for myself, and a talk with my CPA to get sanity checked on. So depending on the numbers here, hey, that might make sense. Now, honestly, in 20 years, if I'm getting 180 versus $210,000, I'm happy either way at this point. Both of those numbers are phenomenal. And if I'm able to withdraw some of that in addition to other investments I have, I should be a pretty happy camper for retirement. Of course, this is all, spreadsheet assumptions. All right, so I know we got a few minutes left, and I'll kind of quickly go through what I'm currently doing with my solo 401k investing plan. So right now I'm 42 years old. I am rolling over actually a little bit more than $276,000 from my Vanguard account, and my goal is to start having distributions in about 20 years. So I'll be 62, right? So the typical retirement age. So I set up my self-directed solo 401k in 2020. I started making contributions then. Wasn't maxing it out, but I started making contributions. I made regular, traditional tax deferral contributions. In 2020, I started making Roth contributions where I was paying taxes today, and my account allows for me to make that switch. And then now what I'm doing is I'm rolling over that Vanguard IRA. I say my IRA. It's actually my wife's old IRA, to give her credit, from one of her previous employers. So it's, our IRA, her IRA. We're going to roll over in the 401k plan because I can invest into real estate. And after, the last 10 years experience I have in real estate, I feel very confident. I want more of my money in real estate and less in stocks. So I'll be investing that money across some of these investments, or investments like this, like I talked about earlier. A lot into debt funds, just because I think it's a very favorable tax advantage where I'm not going to pay ordinary income tax on here. I'm happy making a consistent, 10, 11, 12% on there. I'm happy with that. And then I'll have another chunk of money into these development deals and then to multifamily deals. Those are the three asset classes I personally like a lot right now: debt funds, development, whether it's build to sell or build to rent, and then multifamily, value add multifamily, and also build to rent multifamily in these bigger communities in different parts of the country. Now, I'm not investing $1 million. I'm not quite there yet. That's very aspirational, but that is where I want to go and where I want to be. But that is how I'm investing my money. I'd love to know people's opinion out there of strategies I shared, thoughts I shared, or questions you guys have. And again, two things to keep in mind here: that Property Llama, one of our goals here is to help curate and present some of these private equity real estate investments. And these are from sponsors that we like. These are from deals I'm investing my own money in, and that we think is worthwhile. And I feel, honored to go out there and share with others. But most importantly, you want to go out there and make sure you understand what options you have when it comes to setting up a self-directed IRA, a self-directed solo 401k, or another type of investment. And I always recommend you go out there and research. Go out there and talk to a couple custodians. These are the people that go out there and handle it. It's kind of like they're the Vanguard or Fidelity version of it. They just specialize in these self-directed nuances. Where Vanguard and Fidelity, that's not what they do. They do traditional custodial work. So I definitely recommend reaching out to Equity Trust. They're one of the biggest companies in the industry out there, and their website also has some great educational resources. So go talk with them, go research, and go talk with a couple other custodians as well. So you go out there and get the facts, talk with an expert, and go out there and find the right self-directed investment for you. And along the way, if there's anything I can do to help out with in your journey, any questions you have, reach out to me. I love being a resource, and I would love to help you out. So thank you so much for attending. I appreciate you staying a few minutes over. Enjoy the rest of your day. And then please email me or report back as to what type of, what moves you're making. If you have any questions, any recommendations, again, always reach out. Bye, everyone.